Imagine waking up tomorrow to the news you've always dreaded. The market has crashed. Trillions of dollars wiped out overnight. Retirement accounts decimated. Panic on the streets, mass layoffs, and the talking heads on financial news networks sweating through their expensive suits. It's the kind of economic winter that ruins lives, bankrupts legacy businesses, and leaves the average investor scrambling to salvage whatever is left. But while the masses are panic selling and watching their net worth evaporate, a quiet, elite group of investors isn't panicking at all. In fact, they are sleeping perfectly fine. They might even be smiling. Why? Because they know a secret that Wall Street rarely advertises to the general public. They know that while most of the economy is burning, certain hidden corners of the market are virtually fireproof. These aren't risky crypto bets or overhyped tech startups. These are the boring, invisible giants that secretly run our lives. Recessions are not the financial apocalypse they are made out to be. They are simply wealth transfers. Money doesn't just disappear, it moves. And when the economy crashes, it moves directly into 5 specific types of investments. These 5 sectors quietly thrive in downturns. They are the financial bunkers the ultra-wealthy use to protect their fortunes. Today, we pull back the curtain on what these 5 investments are, how they work, and why they secretly profit off everyone else's panic. Look at the illusion of choice and human necessity. When times get tough, you might cancel your streaming subscriptions. You might delay buying that new car. You might stop eating at fancy restaurants and skip the annual vacation. But what you won't stop doing is brushing your teeth. You won't stop buying toilet paper, laundry detergent, or basic groceries. This brings us to the first investment that quietly survives every recession: consumer staples. These are the massive companies that manufacture the absolute necessities of human survival. Think about the colossal empires behind the brands in your kitchen pantry and bathroom cabinets. The brilliance of consumer staples is their utter immunity to consumer sentiment. In a booming economy, you buy their products. In a crushing depression, you buy their products. When markets crash, institutional money floods out of high-flying tech stocks and pours directly into these massive behemoths. They offer steady dividends, predictable cash flow, and a business model mathematically insulated against economic shocks. It is the ultimate defensive play. You're betting that no matter how bad the economy gets, people are still going to wash their hair, feed their children, and clean their houses. This creates a financial fortress that stands tall while everything else crumbles. But survival isn't just about food and hygiene. It's about life and death. This leads us directly to the second recession-proof investment, a sector that literally holds the world hostage to its necessity: healthcare. You can postpone a luxury purchase, but you cannot postpone a heart surgery. You cannot haggle over the price of life-saving insulin or delay chemotherapy because the stock market had a bad week. The healthcare sector operates entirely outside the normal rules of supply and demand. Whether it's pharmaceutical giants churning out daily medications or medical device manufacturers creating the machines that keep hospitals running, this industry is a juggernaut that feeds on human vulnerability. During a recession, people might lose their jobs in their homes, but they still get sick. Economic stress often leads to higher rates of illness and medical necessity. This dark reality makes healthcare stocks incredibly resilient. Investors flock to pharmaceutical companies and healthcare providers because their revenue streams are practically guaranteed by the basic fragility of the human body. When you invest in healthcare during a downturn, you are investing in the biological imperative to stay alive. It is a calculated and wildly profitable safe haven. Now, let's step outside the human body and look at the infrastructure that keeps modern civilization from collapsing. The third investment that quietly survives every recession is utilities. Imagine your city during a severe economic depression. Businesses are shuttered, spending is down, and the streets are quiet. But the streetlights are still on. The water is still running when you turn the tap. The natural gas is still heating homes. Utility companies, the regional monopolies that provide electricity, water, and gas, are the ultimate hidden landlords of society. You do not have a choice in whether you pay your electric bill. If you don't pay, the lights go out. It is the very first bill everyone pays, prioritizing it above almost everything else. because these companies provide critical infrastructure. They are heavily regulated by the government, which essentially guarantees their profit margins. They operate as legal monopolies in their respective regions. They don't have to worry about a trendy new startup stealing their market share. This lack of competition, combined with mandatory demand, transforms utility stocks into financial anchors. When tech valuations are plummeting, the utility sector just keeps steadily collecting mandatory tolls from every household. It is boring, slow, and bulletproof. What happens to human behavior when the stress of a recession becomes too much to bear? When the bills pile up, the job is gone, and the future looks bleak, people look for an escape. This brings us to the fourth, and perhaps most cynical, investment that survives economic collapse: vice. Also known on Wall Street as sin stocks, this sector includes alcohol, tobacco, and gambling. Human history has proven time and time again that during periods of extreme psychological and financial distress, the consumption of alcohol and tobacco does not decrease. It often goes up. People self-medicate. They seek cheap, immediate dopamine hits to temporarily numb the anxiety of a collapsing world. The companies that manufacture cheap beer, mass-market spirits, and cigarettes have incredibly loyal customer bases whose purchasing habits are deeply ingrained. This means their revenue does not dry up when the economy contracts. Vice companies boast insanely high profit margins and require very little innovation to keep making money. A whiskey distillery just needs to keep selling the exact same liquid they've been selling for a century. Investing in vice is betting on the unbreakable coping mechanisms of human nature. Sin stocks are resilient fortresses of cash flow that quietly enrich their shareholders while the rest of the world drowns its sorrows. Finally, we arrive at the fifth investment that feeds on economic panic: discount retailers. When inflation skyrockets and paychecks shrink, consumer pride goes out the window. People who previously shopped at expensive boutiques are forced to hunt for bargains. They migrate en masse to big box discount retailers and dollar stores. These companies are masterfully engineered to profit from anxiety. Their business model relies on ruthless supply chain efficiency and razor-thin margins over massive volumes. When a recession hits, they experience an influx of customers trading down from pricier stores. Their sheer size gives them unprecedented negotiating power, keeping prices artificially low. They are the ultimate beneficiaries of economic downgrades, sucking in all the desperate spending. Consumer staples, healthcare, utilities, vice, and discount retailers. These 5 sectors are the secret playbook to navigating financial collapse. The wealth doesn't vanish. It flows to those who know where to sit. Position yourself behind these walls before the next storm arrives.